The year is 2025, and you're looking back on this past year applauding yourself for doing one heck of a job doubling, tripling, or just compounding your money. Now, that choice is actually yours to make right now, today. And if we're really all being honest with ourselves, there's one thing that's actually better than turning profits from the stock market, and that's earning income every single month. The ultimate passive income victory. So I want to go ahead and talk about 6 dividend ETFs that will do just that. Ready? Now, if you're new to investing, I want to go ahead and cover some of the basics here when it comes to dividends. What are they and why you should absolutely love them? In short, dividends are payments made by a corporation to shareholders, or the everyday Joes like you and me, investing into a company. And when it comes to investing into, say, a dividend exchange traded fund or ETF, we're talking about investing into a basket of companies all performing on par or better than to afford to pay us those dividends. So really, we can't lose based on the law of diversification. Now today, we're going to go ahead and talk about monthly paying ETFs, which is not only exciting, but incredibly motivating. However, there is one thing about monthly paying dividend ETFs that every investor should be well aware of, so stick around for that because it is certainly a risk. Either way, let's get to it here with our first monthly paying dividend ETF. We have the Wisdom Tree US High Dividend Fund, ticker symbol DHS, which was designed to track the investment returns of the highest yielding companies in the US equity market that will ultimately grant you exposure to larger cap companies with a passive income orientation. Now, it's best to familiarize yourself as much as you can with what's underneath the hood of these funds by analyzing which sectors they focus on. So we're going to go ahead and jump into the sector breakdown here and find we have the financial sector weighting in around 24.81% worth of the entire fund, followed by the energy sector at 17.68%, utilities coming in at 14.26%, all trailed by consumer staples and the healthcare sector. But further breaking down the fund's 385 positions, its top 10 holdings work out to be AbbVie, Chevron, ExxonMobil, Altria Group, IBM, Philip Morris, Morgan Stanley, Bristol Myers Squibb, United Parcel Service, and Citibank, which if you know anything about your macros, you know that these are all great picks for the year ahead. And speaking of potential performance, let's dive into how it's been faring over the past decade, though that's not necessarily the indicator of future performance. But let's say we invested $10,000 into DHS and totally forgot about it while every dividend payment was reinvested. We'd now be sitting on $21,531.11. Not too shabby, but given we're here for the dividends, the dividend yield with DHS is coming in at 4.11%, yet with a higher expense ratio here sitting at 0.38%, meaning you're going to pay $38 per $10,000 invested on an annual basis. Now, just to cement in the idea of investing into a dividend ETF as opposed to just focusing all of your efforts on a dividend stock, let's have a look here at DHS's performance here in blue when compared to, say, every dividend investor's favorite monthly paying dividend stock, Realty income. To see that exchange-traded funds, if selected intelligently, provide you that safety that you deserve after working so hard for your money. But DHS is only one out of the 6 on our list today, so let's keep going here with our second monthly paying dividend ETF, the Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD, which I'm sure you can now guess from the name, it's really aiming to reduce all the shock and awe moments we as investors experience, but still deliver through on driving income to shareholders by specifically focusing on high dividend holdings. In other words, this fund is composed of 50 securities all traded on the S&P index that historically shelled out higher than average dividends that really don't falter all too much when the economy gets rocked. Now, you should also note that this fund is actually rebalanced semi-annually, once in January and once again in July. So we may see some alteration shortly, but as of this video, this fund is actually coming in at 17.48% worth of its holdings allocated towards real estate, followed by 17.27% worth of the holdings in the utility space, another 13.62% of the 50 securities here in the consumer sector space, followed by an emphasis on materials in the energy sector. However, you may be quite surprised then to see that AT&T is its largest holding, and then that's followed by Verizon, so 2 telecom giants before a spread into Simon Property Group, Altria Group, and International Paper Co., all making up the fund's top 5 holdings. Insight-wise, SPHD gives shareholders with 4.73% of the dividend yield, and going back in time, roughly 10 years, investing that $10,000 into this fund, you'd now be sitting on $22,547.78, which is a tad higher than the last fund. This expense ratio at 0.3, it's also a tad cheaper for all of us to invest into this fund. Now, investors, before I actually continue to just talk your ear off about 4 more dividend ETFs, I want to know that this content is what you came here for, what you're enjoying, and you're actually getting something out of it. So tap on that thumbs up button to let me know, and if that's the case, then I want you to take massive action this year by joining me here on the channel. Subscribe to the channel and let's crush our financial goals together. With that, we have another Invesco fund to discuss, and that's the Invesco High Yield Equity Dividend Achievers ETF, ticker symbol PEY, which is based on the NASDAQ US Dividend Achievers Index, with at least 90% of its total assets in dividend-paying common stocks that comprise the index, to which it's rebalanced on a quarterly basis. Now, each stock within this particular fund is selected on the basis of its dividend yield and consistent growth in dividends. So note each holding's high dividend yield is really not a consideration here when it comes to this fund, but over time those dividend payments will be growing. So we have companies like Walgreens, New Skin Enterprises, Kennedy Wilson Holdings, Leggett & Platt, and Altria Group that make up the top 5 holdings in this fund. But collectively, the fund has the vast majority of its holdings within the financial sector, followed by utilities, and then investments within consumer staples, materials, and the consumer discretionary sectors. But this fund's performance speaks for itself here, as we discover a $10,000 investment into the Invesco High Yield Equity Dividend Achievers ETF 10 years ago means you'd now have $26,800.46 in your account, thanks to the sheer appreciation in dividend income from a dividend yield coming in at 4.87%. But nothing here in life is free. You're going to get charged a higher fee, coming in at 0.52%, equating to $52 per $10,000 invested annually. Next up, an ETF that will cost you less and drive you higher returns. We have the SPDR Dow Jones Industrial Average ETF Trust, ticker symbol DIA, which is ultimately seeking to provide investment returns that, before all the fees and expenses, correspond generally to the price and yield performance of the Dow Jones Industrial Average, or the 30 big blue chip US stocks. So we're really talking about stocks like United Health, Goldman Sachs, Microsoft, Home Depot, and Amgen, which actually work out to be the fund's top 5 holdings, with the vast majority of the holdings within the financial sector making up about 20.93% of the fund's weight, whereas healthcare comes in neck and neck here at 19.69% worth of the fund's weighting, followed by investments in information technology, consumer discretionary, and the industrial sectors. Now, all in all, this would be a really safe fund in my book, given the Dow Jones Index is the oldest continuous barometer of the US stock market and the most widely quoted indicator of US stock market activity. And we see that is in fact the case after taking a look at past performance here. With a $10,000 investment made into this fund, you'd now be sitting at $28,173.66, all for that lower expense ratio of just 0.16, meaning you're only paying $16 per $10,000 invested annually, and get this, a lower dividend yield at 1.8%, meaning that dividend yield should not be your only consideration when making dividend investment decisions. But with that in mind, how about we talk about our options? Literally with an options-oriented ETF, that's the JP Morgan NASDAQ Equity Premium Income ETF, ticker symbol JEPQ. Now, many of us are familiar with its sibling JEPI, also focused on options, but JEPQ caught the attention of plenty of dividend investors and has actually delivered quite well despite only being created back in 2022, all after a year like we just had when tech was on the run. This fund is worth your attention as it seeks to deliver monthly income with tech-oriented NASDAQ exposure while capitalizing on an options overlay strategy, which is how the fund shells out quite an attractive dividend yield. But before we get to that dividend yield, I want to go ahead and explore the fund's top 5 holdings with you. Out of the 92 total holdings, we're talking about Microsoft coming in at the largest holding, followed by Apple, Google, Amazon, and Meta, making for sector exposure in communication services, consumer discretionary, consumer staples, the energy, and financial sectors. Now, as mentioned, the fund was created back in 2022, so we can't go back 10 years ago to see this performance, but to that date of inception, we'll invest $10,000 and we'd now be sitting on an extra $1,930.42. And likely, as we proceed into the future of tech, JEPQ will remain a go-to for many, especially with its 11.33% dividend yield. That comes at a cost, not the highest, but nonetheless a cost here at $35 per $10,000 invested, with that expense ratio at 0.35%. But if you want to revert back to a less risky investment option, let's check into the Wisdom Tree US Quality Dividend Growth Fund, ticker symbol DGRW, which aims to track the investment results of the dividend-paying large-cap companies with more growth characteristics across the entire US equity market. Now, performance-wise, I want you to check this out. A $10,000 investment made 10 years ago into DGRW would now have morphed into $31,300 $366.56, all thanks to the tech orientation here, with 27.5% of the funds weighting in the tech sector, another 18.18% in healthcare, before spreading into the industrial, financial, and consumer staple sectors, breaking down into 301 total holdings, with Microsoft, Apple coming in as the fund's largest top two holdings, followed up with plenty of safety from Johnson & Johnson, AbbVie, and Broadcom. So all dominant industry leaders that have experienced plenty of growth. Insight-wise, we're talking about a dividend yield coming in at just 1.71%. So again, another case for why dividend yields should not be your only consideration. But it also comes in now with a slightly higher expense ratio, coming in at 0.28%, meaning $28 per $10,000 invested annually. Now, what do I all want you to be well aware of? That risk factor. Monthly dividend income is exciting, but it should not be everything to you. A matter of fact, there are far more ETFs that are out there that pay quarterly dividends that always outperform the monthly paying ETFs. And when you understand that there's really only a nominal difference when it comes to when you actually receive your dividend payments, you might just want to check into all of your options. But now let me know your thoughts on today's picks, if they're in your portfolio, if you're a fan of monthly paying dividend stocks, if you have better ETFs in mind. Comment all of your thoughts down below. If you're looking for more insights, find them right here. Before you actually click away, go ahead and subscribe to never miss a single dividend stock idea.